Hello, everyone. My name is Guy from the group Patrimonium. In 1952, Dr. Markowitz developed what was called modern portfolio theory, which is based on the idea that investors are rational and aim to maximize returns and minimize risk. If we move forward 50 years later, two psychologists, Daniel Kahneman and Tversky, develop what is known today as behavioral finance, which revealed quite a bit different reality, meaning that emotions and cognitive biases heavily influence our financial decisions. So I wanted to do a little bit of a capsule today, a little videos in regards to maybe some of the elements that have been pretty volatile for the last couple of months, the Trump effect, and talking about the uncertainties of the markets. But what we often say is that uncertainties gives us volatility. Volatility gives us opportunities, and opportunities gives us peace of mind through what is called diversification. And we've talked about this, so I would like to go through the entire elements of moving from uncertainties to diversification and peace of mind, and try to integrate the two, the rational portion of it, as well as I would say, the irrational portion of the human beings. So obviously, everything that is said here is our opinion of the group. And a striking example of these dynamics of the Trump effect is a phenomenon when markets react so strongly to the statements of President Trump. As we can see here, I don't make deals for the money. I've got enough money. I just do it to do it. Or people love me, and you know what? I'm very successful. Everybody loves me. And my whole life is about winning. I don't lose often. I almost never lose. And so I often say that it's very coherent because, his actions are coherent to what he says. Obviously, all these dynamics, all these statements, and kind of affect sometimes, especially when we talk about the tariff threats for the past few months, as a direct effect on our emotions. So obviously there's those decisions, and it creates uncertainties. And every time that there's uncertainties, we always think it's doomsday. So, and we often say that it won't be like that. It's never been like this, and it will never be like that again. So what I wanted to show here is that whomever is in place, and I went back from 1980 to today, as you can see, is that it's not a straight line, but there are ups and downs. But what I wanted to make sure that I discuss here is that on average, every year and a half, we have what we call a correction. And a correction is when from the top, we have the market that goes down by more than 10%. So think about it. On average, since 1980, we have 10% correction every year and a half. So we should expect to have correction of 10%. And actually, since the beginning of the year, and especially just in the past few weeks, we've had that correction. And that correction is shown here. So we can see that from the top, where we went down, where we were just a few days ago, down to 5770. So that's the S&P 500. And then I wanted to bring a bias that we see in this instance. From 1980, it's long-term. We always say that we need to look at it at the long term. It makes sense because, as you could see from the other graphs, the markets go up with fluctuations. When we bring it down to a shorter period, and we call that the recency bias, is we look at it and we say, oh, we were high, and the uncomfortable position to see our portfolio go down is just normal. It's our emotions taken into place and just saying that I do not want to go back to where I was before. And it's totally normal as a human being to do so. But as we can see, If we try to kind of eliminate these emotions and stay rational behind it, we can see that after a while, it goes back up. And again, from that top, it goes down. So from top down, there are corrections. That's the volatility. And once we've reached a point, we just don't want to go back down. But I wanted to show you here that sometimes when we look a little bit longer term, we have a tendency to forget that that's where we were. And what we call from that number that we have in our head is what we call the anchoring bias. So the anchoring bias just means that you were at one point in your portfolio when you look at it, and you just don't want to bring it down or for your portfolio to go down. So for us, it is a cognitive bias. And what we need to do is just make sure that we look beyond just that shortness or that from top down and just say that, okay, let's look ahead, let's look forward, and just make sure that we look longer term when it comes to our anchoring bias. So whenever you ask yourself, I don't like it when I was at that number and it goes down, just be aware that it's what it's called, the anchoring bias. So I did mention that uncertainty creates volatility. I wanted to show you a couple of graphs here in terms of what we're saying and what we're seeing in the market right now, and what we can do from that volatility in terms of opportunity. So basically, what we're seeing is that obviously the red line, it's just elements from the Trump integration, his first mandate, to the trade war, to the pandemic, to the tariffs. I guess we could say that. So that's the global economic policy uncertainty index. That's where it's been for the past 25 years. It's been pretty much at its peak, even a little bit higher than the pandemic that we had in 2020. But what we like to look at, and when we say about opportunities later on, is that we look at what we call the stock market volatility, the VIX index. And surprisingly, when we look at it, we see a tendency to go up, but 20 here is the norm. We've had very low volatility for a few years, and obviously, as a human being, as a person that believes in behavioral finance, we prefer when there's no volatility. But when there's no volatility, there's not as many opportunities. So we can see here with the tendency, it might go up, and I wouldn't be surprised for the VIX to go up. But if the VIX goes up, this is where we want to switch our portfolio to be a little bit more aggressive. So obviously, uncertainty creates volatility. There's absolutely no doubt about it. But so far, we don't see it much in what we call the fear index, the VIX, the stock market volatility. Now, obviously, in terms of the consumer perception, we know that the consumer is really important. The concern right now is that, well, it's gone up a little bit, but it's what their concern is that the consumer inflation expectations being at 3%, the central bank since 2000 wanted to keep the inflation between 1% and 3%. Lately, we've been a little bit more towards the higher part of the 3% due to the 2022 war in Ukraine. So right now, the expectation is for inflation to go up. That was a little bit of our concern in 2024, even before the new elections, where the tendency of the inflation seemed to be a little bit high. So obviously, with the tariffs moving forward, if it does happen, it'll create inflation. It's just a matter of fact. So that's where everybody's a little bit on the stand and not sure of, is it going to happen? It will happen, no doubt. At what percentage and what will be the impact? So we're going to have to look ahead and see what the GDP is. We're going to have to look at what the inflation is, and we will adjust based on the inflation numbers, our portfolio. But again, this volatility, the fear that the consumer has will bring opportunities. And the opportunities that we can see, we wanted to put it into one stock. Obviously, if you put all your eggs in one basket and the basket, you drop the baskets, it's not a good thing. But we want to show that sometimes we have a little bit too nearsightedness, short-sightedness. So, and it's CGI. It's a Canadian stock. And if we are to look from the top down, what we just saw with the S&P 500, we can see that the stock was at over 170 and went down to 150. So it's a $22 drop from the top down. If we look at it for 1 year, however, it was just a drop of 6%. So the stock started at 160, a little bit below 160, and that's at 150. So obviously we see the fluctuation, but for us, we look beyond just what's going on in terms of the performance. We're looking at it about the fundamentals, and we're looking at long term. So for the past year, it hasn't done as well as it should, but for the past 5 years, however, we've almost doubled our money. So for us, we look at it and say, okay, we like the tendency of the 5 years. We like to see the stock doing pretty well. And what's the fundamental? Does it make sense today with a small drop to look into this stock and buy it? And we look at it from an economic value added approach, EVA approach, which we've done for the past 25 years. So we look at the NOPAT, the net operating profit after tax, and we can see for the past 5 years, and the results should be coming soon for the first quarter of this year, of 2025, we can see the upward trend of the NOPAT. So 1.6 billion to 1.7 billion to 1.9 to $2 billion. So we like that tendency when it goes up. So even if the stock goes down and the fundamental is good, well, we like it. So another way to look at it, and we made it very simple here because there's a few other numbers that we could look at. But if we look at the return on capital, we like the tendency of the CGI stock going from 12% to 14%. So all these two elements tells us is that it is an opportunity. The stock hasn't done as well compared to the index on the past year. But if we're patient enough, and if we believe in the numbers, the fundamental, the rational portion of the market, well, we can see a great opportunity here. And that's what we wanted to show you. It's one specific example, but this volatility will create opportunities. Now, what we want is obviously opportunities. We want to create your peace of mind. And the best way to create it, and Dr. Markowitz that I mentioned at the beginning, the modern portfolio theory, brings us about, in simple terms, about diversification. And diversification through asset categories. So what we want to show you here on this graphic is that the kind of the reddish line are the global equities. We've shown you at the beginning of the presentation that the S&P 500 was as corrected, and it was a little bit below. It didn't show on that graphic, but today was a little bit below, was negative, below 0% return. I think it was minus 2% at the beginning of the year, since the beginning of the year. But if we diversify it with Canadian stocks and international stocks and Asian stocks, we see that diversification is paying off. Does it always pay off short term? Not always, but currently, due to this volatility, we believe that by diversifying through all the asset categories of the stocks, from Canadian to US to international and Europe and Asian, we believe that we're diminishing the risk of your portfolio, which we always say the volatility of your portfolio. Now, on the Canadian bond side, the bond categories, we've just looked at the Canadian bonds index here, and it's done pretty well. It's done what it's supposed to do. It's not supposed to give us great returns. 2022 was an outlier year. It was the first year out of 40 years. We cannot forget about that. Outliers are important, but we have to put that in perspective. So moving forward, we believe that the bonds will do their job to protect the capital and to give us opportunities when the equities don't do as well. The bonds should protect us, and then we'll reallocate and we will readjust the portfolio in consequences. So as we wanted to show here with the blue line, the darker line, is that a 60-40 portfolio, which is ultimately a very, very good asset allocation, especially if you're retired. But it's just one example among others. We can always adjust those equities to bonds. But in this instance, being balanced, being diversified through asset categories has done its job. So as of today, March 10th, this is our balanced portfolio, our asset allocation. So we are, as you can see, pretty neutral. The numbers to the right are what a balanced portfolio is. To the left is what most of our clients are with that portfolio. Pretty neutral in terms of fixed income being bonds. Canadian equity, we're pretty neutral. The US equity, we are a little bit overweight. The reason why we're overweight, we believe that it's still the strong economy. As a Canadian investors, obviously, having US stocks gives us an advantage when our currency, the Canadian currency, doesn't do as well against the US. So the US stocks protects us. So it becomes somewhat of fixed income in terms of the dollar, the currency. As far as international equity, called foreign equity here, we are a little bit overweight simply because for the past 10 years, Europe hasn't done as well. So basically, we believe that they are a little bit cheaper. Asian markets right now are doing pretty well since the beginning of the year. It's funny because for the past 2.5 years, they've been in recession. It's not done very well. So it's always when something doesn't go well, that's when the opportunity are. So we have to be patient sometimes, and that's why when we look at numbers, we look at a tendency of 5 to 10 years, and we have to do that. And we want to give an honest performance and honest return based on what's most important to you. And when we say what's most important to you, we believe wholeheartedly in the human beings. So we believe that finance has been lost somewhat, and why we're so adamant about, yes, the modern portfolio theory, but the behavioral finance behind it is because we are emotional as human beings. And what we want to do is we want to take those emotions out, which is very difficult when we hear the news on a daily basis, but we want to take this, bring the rational part of it. But that behavioral finance for us is the future of our industry. And we're really, really focused on this, making sure that we understand all of our clients, their biases, their emotions, and how we can rationally make sure that they're comfortable moving forward with a certain asset allocation in terms of what's most important to you. And when we ask this question for people, it's because we care about the human beings and what's most important to you. Is it to have the best return? Is it to have the most money? Or is it to spend time with family, with friends? Yes, finance is important, but we just want to make sure not only a balanced portfolio, we want to make sure that all our clients are happy, but they have a balanced life. And that's where we move in. So we're going to try for the next few weeks and for the next years coming forward to do a lot of capsules, a lot of videos about the behavioral finance and some of the biases. And just for people to be aware that if ever you have one of those, we can have a fun conversation to make sure that let's stay rational, because based on these emotions, often we don't make the most optimal decision. This said, we wanted to introduce you to our two friends, Charlie and Lison in French. You will see them regularly moving forward when we talk about emotional biases. I'll let you know which one is rational and which one is more emotional, but we'll have fun with it. Thank you and make it a great day.